Hi, Andy Jewell from Agent Insider here. Just wanted to share with you guys a question that we see a lot about life insurance. We've had a couple of episodes specifically on life insurance, the difference between term insurance, whole life insurance, universal life insurance. We've kind of gone down that road already, but I wanted to address the question about life insurance premiums and if they're tax deductible. The short answer is they could be, but I would not recommend them to be. So if you're paying for a policy through your business, like a key man policy, so I say, hey, if something happened to Gerald in my business and it would be a major impact financially to the business can buy a policy on Gerald. And then if something happens to him, the business gets paid out and then they use the funds to replace him or to offset the loss in business. If you deduct those premiums, and in that case, maybe you do because it's a business transaction. But if the premiums are tax deductible, then the benefit is not tax free. So it's oftentimes not a great idea. So probably a more common one would be a buy-sell agreement that you might have multiple owners of a business and they take out insurance policies on each other. Now, if I take out the insurance policy on my business partner and I just pay the premium and then something happens to my business partner, the proceeds of that life insurance policy comes to me tax-free. If that business pays for those premiums and deducts the premiums as a business expense, then the proceeds are not tax-free. Those are going to show as income to the business. The same thing is true when it comes to like a disability policy. The reason why disability payments from a disability insurance policy are not taxable is because you're not deducting the premium that you paid for that policy. In general, on a personal life insurance policy, if you have a policy on your spouse, you're not going to deduct you're not going to have a tax deduction for the premiums you pay on the life insurance. However, the benefit of the life insurance, the face amount when it's paid out, is also not taxable. So that's kind of the general rule. If you're not paying tax, if you pay tax on the premium, you're not going to pay tax on the benefit. But if you take a tax deduction through a business on the premium, then the benefit is going to be taxable income to the business. So it's actually more beneficial to just pay the tax on the premium because you're paying tax on that $50 or $100 a month that you're paying on the life insurance versus paying tax on the benefit of, $500,000 or $1 million. In general, which we dug deeper into this question when we talked about whole life insurance and the cash value part of it, the premium, the reason why the life insurance can work so well for you is because it's creating like this giant Roth IRA, if you think about it. And so a Roth IRA, you're not getting a tax break when you put money into it, but you're not paying tax when you take money out of it either. So the life insurance, you can kind of think about it in the same way. When you put money into your life insurance, you're not getting any tax deductions. On your personal tax returns, there's not even a place where you could list life insurance as a tax deduction. But when it pays out to you, you're not going to pay tax on the benefit. If you're using life insurance with a cash value, it's going to be the same thing. You can put money into that cash value life insurance. So you could overfund it. You can be putting a ton of money in there and it's being invested into sub accounts and that cash value is growing, but you're not getting any deduction when you put the money in. As it's growing, as long as it's inside that life insurance policy, you're not paying any tax on the growth. And then if you take money back out of it, you're not going to pay tax on the money that you put in because you already paid tax on that. So a lot of times people will say, well, I want to withdraw money out of my cash value life insurance when I'm going into retirement. It's like, okay, that works. And that's a great strategy. The way you do that, you can avoid taxes altogether on the withdrawals by taking out first the money that you put in premiums, and then the growth that you have on there, you actually don't do a withdrawal, you do a loan against it with the life insurance company. And by doing that, you're not going to pay any tax on that money because it's a loan. So the life insurance company, and they'll have a set period of time, and each company is going to be different. It's going to usually be between 11 and 20 years. I've seen some go all the way to 20 years that you have to have the policy first. But what they'll do is you have a self-secured loan. So if your cash value is, $700,000 of cash value in my life insurance policy, but I've only paid in, maybe 200,000 of that 700. So the first 200,000 is just a withdrawal of the premiums I've paid. No tax implication to me. I didn't take any tax deduction when I put it in, and I don't pay any income tax when I take it out. Then when I get down to the 500,000 left in my cash value, all of that was earnings. All of that was growth and interest rates that I got back. Instead of doing a withdrawal out of that account, I take a loan against it. And the life insurance company sends me that, $50,000 a year, and they take $50,000 and they put it into a secured account for my loan. It's securing my own loan, and it pays, that secure account will pay like a 3% interest rate, and it charges me 3% on my loan. So it's a net zero. It balances each other out. And then I never pay the loan off, because then when I pass away, the secured account pays my loan as part of my benefit. So it's part of the death benefit on my life insurance. And death benefits of life insurance are never taxable. As long as you didn't deduct the premium that you used to build it, then the death benefit is not taxable. So you could take a loan against your cash value, and then the loan is paid off with your death benefit, which was not taxable. So then you were able to get the money all back out of your policy with no tax implications. So it's kind of a different way of doing it, a different way of thinking about it, I should say. It's not a different way of doing it. It's very common in cash value life insurance. So a long-winded answer to a short question of, is life insurance tax deductible? On a personal note, no, it's not. And you don't want it to be, because you want the benefit to not be taxable. And then on a business policy, it could be, but if you can keep it from being a tax deduction, you might be better off, because then you're not going to have the benefit be taxable income for the business. So it kind of depends how you want to structure it. If it's a business policy, on a personal policy, it's not, and it really shouldn't be, because it's in the long run going to work better for you. So hopefully that's helpful and answers some of those questions about, is life insurance tax deductible, the premium's tax deductible. And if you have more questions about it, if you have follow-up questions to that, feel free to shoot me an email. My email address is theagentinsider@gmail.com. So that's theagentinsider@gmail.com. Thanks so much, guys. I hope you have a great day. Until next time.